Hello, everybody. Kirk Spano, and this is Macro Dash's Global Trends ETF, whatever else I feel like talking about. Today, we are going to focus on clean energy and what appears to be an inflection point that will probably offer two entries in the next several years, one of them that is upon us. But first, I want to just talk about the YouTube channel a little bit. I am making a change. I am getting rid of the $1.99 a month paid subscription. It was more of a nuisance than anything else to keep people away from getting our stock picks for free. I don't know that it worked very great. However, it really just didn't serve the purpose of building the YouTube channel up really big. So I'm going to go back to everything free. However, the stock specific videos will often be on an unlisted URL, meaning it won't pop right up on the YouTube channel. You'll have to get it from the chat room. So here's an example. The punch card stocks was behind the paywall. It no longer is. It is listed in secret, I guess. It's an unlisted URL, meaning it doesn't pop up on the YouTube page, but I can post it here. So if you want the videos in real time, all you have to do is go to your appropriate chat room and you will find them. And yeah, this gets rid of a little bit of expense for you, creates a little bit of a little extra work for me. However, I didn't really look at this as a profit center. I was just looking for ways to protect the content. And it seems like the best way to protect the content is just to do a little extra work and put these into the chat room via an unlisted URL. And I do have a setting where I'm allowed to turn this public after a while. So what I'm really doing is that I'm embargoing these 3 to 4 months. I just set a turn public notice in YouTube, and it automatically turns it public. They didn't used to have that. By them adding that, it made my life a lot easier. I don't have to go back and find the unlisted videos and then change them to public after a while. So that's what we'll be doing going forward. And yeah, hopefully it makes life a little bit easier for everybody in the long run, and maybe drives a few more people to subscribe to the investment letter. So Jeremy Grantham, I talk about him all the time. His firm is GMO, which is Grantham, Mayo, and some other dude. I forget who it is. But back in 2019, he wrote How and Why to Invest in Climate Change Strategy with Lucas White, who is also still there, I believe. I would bookmark the GMO website that you can sign up for free, and you can get their research papers. And I want to talk about climate change strategy because I think for most people, especially most smart money people, it's becoming very apparent what's going on in the world with climate change and where the capital is flowing over the next 10 to 20 years. So I think it's important to really grasp this. This week, of course, I will be going to Fort Worth to the Super Doug convention. And it's really, I want to hear what they have to say about certain topics. I want to hear what they say about AI, helping them with drilling and recovering oil and gas cheaper. I want to hear what they have to say about carbon capture. And I want to hear really what their strategies are in this clean energy transition. We know that the fossil fuel industry, one of their big strategies is just to talk shit about clean energy and hopefully get politicians, generally by buying them, to help them extend the life of their businesses. And they've, been pretty good at that. Clearly a lot of our politicians are bought and paid for by special interests. I don't know how we get over that. You will notice that President Trump promised, you still call them president, even when they're an ex-president, you still call them president. It's a respect for the office, even if you know my feelings on the man. But President Trump basically went right out and publicly said, hey, oil and gas guys, if you back me, I'll give you this, that, and the other thing. So not the best ethics. But I think it's very transparent to know who is trying to be bought by whom. I mean, I don't know how it gets any clearer than that. So what we have seen, and we talked about this with the REITs a week or two ago, is that construction spending has gone way up. And this is not just on manufacturing plants, but all the equipment. So you've seen manufacturing construction really shoot up under President Biden because the whole reshoring thing has really taken off. It started to move under President Obama, stalled out over the term of President Trump, and that really was because the CEOs didn't know what to make of the guy, and now it's shot up under President Biden. I think you really ought to take this as what it is. The CEOs spent money on reshoring under Obama, flattened it under Trump, and skyrocketed under Biden. Part of this is the Semiconductor Act and the Inflation Reduction Act and the infrastructure bill. But take a look at this. This is dramatic. Manufacturing construction has tripled in just 3 years. And that's a big deal. And we are starting to see a major rebound in American manufacturing and industry. Typically, when the ISM prices paid index reverses from below 45 to above 60, which is just getting to now, you see the manufacturing and industry sectors take off. So that's the Spider Industry ETF, XLI. And it looks like we're just about to do that. So people are talking about the next recession. I do think there's a boomer retirement crisis coming that we've largely mitigated by using the last crisis to overspend to try to avoid the next crisis. And it looks like we're going to have a manufacturing boom. We're still short on labor, even with the recent immigration. They have to be normalized into the workforce. That'll take years. However, we do know that AI and robotics are coming pretty quick. So the change that we're in isn't just manufacturing, though. It's also clean energy. Because what has a lot of this money gotten spent on? Well, clean energy spending is going to approach $2 trillion globally this year, right? That's a lot of money. That's more than the U.S. deficit. So that's a lot of money going towards clean energy spending. And where has that gone? Mainly EVs, electrified transport, renewable energy, and the power grid. I talk about a utility company that owns a major grid company as a subsidiary. Nobody values that. And yet, this is where all this money is going. I've told you, I have a friend that works for the company. He's about 35 years old, and he's got a really fat 401k because he gets profit sharing in the grid company. Electrified heat is the next one that's coming, and then general clean industry, trying to clean up industry, and energy storage is also going to take off. The thing that's not going to take off is nuclear. It's already way down here. Yeah, are we going to extend the life of a couple plants? Are we going to build a couple more over the next 20 years? Sure. You're not going to see 50 nuclear power plants built in the United States, though, which is, probably what it would take if we wanted to not use, coal, gas, solar, and wind. We're just not going to do it. So these other things are going to ramp up. The power grid will get built out, so it'll surge for the next decade and then peter out. Renewable energy will surge for the next probably 2 decades and then peter out. And EVs will surge for the next 2 decades and then peter out, right? All these things normalize over a long period of time. And the change is slow until it becomes very rapid. And I just want to show these pictures to you because I think they're pretty cool pictures. They had them over on Forest for the Trees. Oh, sorry about that. New York City in 1900. See all the horse and buggies? And there's one car. 13 years later, all the cars and one horse and buggy, right? So it's a slow change until it's a very fast change. Now, what have we seen over the last few years? Clean energy stocks spiked on the hype and then came down. This is exactly what the Gartner hype cycle looks like. And now we're going to go into that adoption phase. And what do we see here? The gas and oil stocks are peaking while the clean energy stocks are cratering. Again, what does that look like? We look for alligator jaws. These are alligator jaws. You know that I have a exit strategy on the fossil fuel companies over the rest of this decade. I have extended it because COVID created an opportunity. But what you're going to see is probably this become choppy and flat until it falls. And this is going to start chopping higher. And these alligator jaws will close and then open up in the other direction. Now, there will be a point at some juncture in history, 10, 15, 20 years out, where the pessimism on oil and gas stocks just destroys them, right? And a lot of them will probably get taken private. However, at some point, there is a big oil and gas crash. people will just price it for oblivion. But really, we're going to use some oil and gas until the end of the century. So there could be a pricing opportunity where people say, well, we're pricing it for zero, in their account, but the reality is we're still going to use it. So that's a discrepancy. It'll be a big overshoot, and we can keep an eye on that. Right now, I think the oil and gas companies are going to just buy back shares, and consolidate. They're going to use technology, the AI in particular, to make their processes even better and keep their costs down, even as the oil and gas gets harder to extract. And with Saudi Arabia needing, this year they need $108 a barrel to balance their budget. They're not going to get it, I don't think. But in the long term, they only need around $80 a barrel to have a roughly balanced budget over a longer, smoothed out time period. So $80 a barrel seems to be kind of the bogey. When we're below it, it'll bounce back up, and when we're above it, it'll come back down. 80 is kind of the equilibrium on oil, because that's what a lot of the countries, in particular Saudi Arabia, need so that they can, not go into deep debt like, most of the world is. So these alligator jaws close. Now, Grantham talks about an idea that I've talked about. He just put this out in March. This is going to sound a lot like things that I have said to you for the last 3 to 4 years, right? The whole build back better thing. Compound growth can't last forever. Why? Because something will just get too big. And he uses an example of the population of Egypt, 2500 BC. Had it grown at 1% per year for the next 3,000 years, and it was growing at 1% at one point per year back then, everybody would be Egyptian, right? So the law of small numbers allows for large compound growth rates, but the law of large numbers means that compound growth rates have to shrink. Otherwise, the thing that's compounding in growth just gets too big. And eventually, you see the curves bend over. We have seen that in a lot of sectors of the economy already. And it is important to understand that there's a trade-off. So everything can't grow forever. So where do we get growth from? And it's going to be goals-based, meaning what are we trying to achieve with the economy and the world? And the thing that we're trying to achieve mostly, 200 countries have signed on to the Paris Agreement, is the smartest people in the room understand that fossil fuels are fueling climate change that is very dangerous. And they're trying to stop it before it destroys us. And I don't have any doubt that they will, because the technology allows us to clean things up over 20, 30, 40-year periods, over a generation or two. So as we move towards carbon neutral sometime this century, I don't think it'll be by 2040 or 2050. It'll be a little bit later than that. We will also start to just clean up the environment. And some catastrophe will push the dialogue. It'll change the narrative. I don't know when that catastrophe is, and neither do you, and there's no reason that we should bother speculating on it when we know that soon is just soon. Is it this year or is it in 5 years? I don't know. But at some point, there's a climate catastrophe somewhere. I would speculate that it's a U.S. city on the coast that just gets decimated by a storm. And then people start talking about it. Wow, we've never had a storm that strong. Where the hell did a Category 6 hurricane come from? And that's what's going to happen. And I don't know if it'll be New Orleans. I hope not. Miami, meh. New York, I hope not. But it's going to be some city on a U.S. coast, because if it doesn't happen in the United States, a lot of people don't think it happens. It's going to get just totally whacked. New Orleans has done a good job protecting themselves. Hopefully it's enough. Miami has barely even started. So I think Miami is at just gigantic risk. And since that has become a financial center, I would implore you to, when this happens, every single one of you write your senators and congressmen and say, don't bail those motherfuckers out. Mother zuckers. Because they're going to ask for a bailout. Oh, we're so important. We didn't know that this storm was coming. Bullshit. Everybody knows the storm is coming who has a brain. So when that inflection point happens, when that catastrophe happens to change the narrative in the United States, and the oil and gas companies can't keep fudging on this stuff, you're going to see a hockey stick on these companies. So this alligator jaw, when it closes, it'll probably be a straight up move like this. Now, are you going to try to be cute, or are you just going to start scaling in over the next year or so? I strongly recommend that you read these articles at GMO. This is a newer one, Sustainability or Bust, and it's it's spot on. I mean, this guy is one of the best thinkers in the world, and I have tried to learn from him. So, what do we know about what's going on now? We know that President Biden is set to hit China with tariffs on EVs, batteries, and solar panels. Teresa and I just talked about this in the chat. To me, they should be doing something different on the solar panels, but I understand the batteries and the EVs. Why? Because there's huge manufacturing jobs available in those industries forever. Why forever? Because cars and batteries wear out, right? You have to keep making them. Solar panels last 20 to 30 years. So in my mind, we don't need a forever solar panel industry. We need enough of a solar panel industry to make sure we have some manufacturing and the ability to replace things and upgrade things, but we don't need to control 30, 40, 50% of the global market. And that's fine. There's a way to structure it. And again, things that make sense eventually happen after we try everything else. I want to be invested in ETFs that are in clean energy. To that extent, I have shopped around for the best ETFs out there. It is pretty clear that we don't want a lot of exposure to China because of the tariffs, but we might want some exposure to China because of the growth and because of the dominance of their industry and the amount that they export to the global south. So China is the number one exporter of solar to basically all the emerging markets. And that's probably not a market that we're going to crack too much. And we shouldn't really even try. We should let the rest of the world have super cheap solar panels. Because that's important so that they don't start polluting as much as we do and the Chinese do and the Indians do and the Europeans do. Europeans are starting to take a bit of a lead because they're 5 to 10 years ahead of us on some of this stuff. And they've gone through a financial transition that's been hard, but it looks like it's going to come out pretty well on the other side. One of the companies that I think is really important to own is Enphase. I like Generac, Solar Edge. When you screen for Generac in ETFs, it doesn't show up in a lot of the clean energy ETFs, even a little bit. But Enphase does. So you can go to ETF.com, and this is free, and you can scan for Enphase in ETFs. Some of these funds are not very big, so they're not worth looking at. See, 5.9 million in holdings, tiny fund. But the Invesco Solar ETF, 12% of that is Enphase. The iShares Clean Energy ETF, 218 million, so almost 9%. And this is the one that the millennials, for whatever reason, invest in. When you go down the list, you got ACES and you got Q Clean. So I pop up the 5 biggest clean energy ETFs. They're not in order here. You got iClean at 2.25 billion. That's still pretty small, right? And then you have Q Clean at 719 million. ACES and PBW at a couple hundred million, 300 million. And then the solar ETF, which is purely solar, at $1 billion. So if you want to trade solar exclusively, and again, I think that anything that's very industry specific is a trading vehicle, right? You probably don't hold it for years and years and years. You play the cycles, ups and downs. And what I did is I started taking a look at their holdings. So this is ACES, which I'm going to add to the very short list as another entry here. And you take a look at that, 43 companies, mainly American, and it's got an interesting mix. It has a REIT, then First Solar, and then Itron, which is a company we've been aware of for a very long time. I don't even know who this is. Albemarle, which is lithium, Northland Power, Rivian, Arcadium, Enphase. And then when you go through the rest of the holdings, some pretty good companies. This is an alternative for people who kind of want to set it and forget it. It's pretty diversified, but it has an eclectic mix that I think balances things out for people. And the expenses are relatively low, 0.5%. So that's pretty reasonable for anything that requires, some management. But take a look at this chart. Spikes is coming down. Isn't this exactly the start of the Gartner hype cycle? This is exactly what the Gartner hype cycle looks like. A spike, people lose patience, it trickles out, and then you have the period of adoption. Let me pull that up for you, just so you understand when I say Gartner hype cycle. I mean, I think everybody who's been around me for a while knows that. Just put in Gartner hype cycle, clean energy, and there you go. How many of you have not seen the Gartner hype cycle and don't know what I'm talking about when I talk for that? Does anybody not know what that is? Lessons in learning There you go. Oh, I just, see, can't really get it bigger, but this is what a hype cycle looks like, right? You get the hype, you get the crash, then you get the rise. So iClean is the one that the millennials really grabbed onto. You can see how it spiked up here. I mean, that's from $9 to $33 in about 18 months. So more than a triple in 18 months. I would think that we probably get that again because of the size of the industry, right? The total addressable market is just huge. So while spending on clean energy has tripled in the last 4 or 5 years, the price of the stocks are basically about the same. Go back to 2019, prices in the 14s. Right now, it's about where we are, right? So we have this long period of time where the stocks went up and down, basically round trip, haven't moved, even though the total addressable market has tripled in size. Is probably going to triple in size again in the next 5 to 10 years. That's a big deal. So iClean has just a little bit of China, about 9%. I like that blend. It's mainly United States, but then around the rest of the world. So it is a global mix. And I think that you can use this particular fund for good diversification. If we go over to QClean, it's the other side of the story. QClean is pretty much mainly North American. It's all stocks listed on an American exchange. So to the extent China can list here, you could find China on there. But you take a look, and it's got lithium, it's got semiconductors, power systems, Enphase and First Solar. First Solar is protected by the government. Enphase is like Generac and Solar Edge. They're in energy control systems, and you're only going to have maybe 6 to 10, maybe 12 companies that dominate that industry. It's going to be pretty strongly oligopolic. There's going to be an oligopoly there because the scale it takes and the intelligence it takes to run these things is pretty intense. So you're not going to have 1,000 people offering energy management. It's going to be a pretty tight industry, which means that they'll have margins, right? That gives them monopoly pricing power. Tesla, I don't really do much other than trade Tesla, but this is a way along with QQQ to get some exposure to Tesla in case I'm wrong and it doesn't just chop along for a decade. I mean, I think it's going to chop along for a decade, but that makes it a good trading vehicle. And there's probably long-term upside, so to have some exposure. And remember, all of the ETFs are self-correcting. If Tesla doesn't do well, they cut the position. So they have a natural way of following the momentum. If the momentum's down, they cut it. If the momentum's up, they add to it. So it ends up that's why a lot of these indexes work, is because they have a systematic approach to cutting and adding. Also have some Brookfield Renewable in here, which we saw spike in the last week. Last week, I said keep an eye out for Clearway. Clearway jumped, a couple days after I said it. And then they have Rivian Automotive and Lucid. I'm not in love with these. I think long term, they both do all right. However, I'm pretty sure Lucid, which has a huge position, Saudi Arabia owns 2/3 of this company. So they're going to survive. They have the financing to survive. They're going to probably dilute more. It's hard to be a shareholder, but it looks like we're getting to the bottom on Lucid. Maybe it has to drop 50% more. It's about 6 billion in market cap. Probably has to go down to 3 or 4 would be my guess. But I think the Saudi Arabians might cut a deal with a GM or a Ford and say, hey, why don't you make Lucid a model in your lineup? The Lincoln Lucid, anybody? I could see that deal happening, which would be good for everybody. Saudi Arabia gets a big piece of Ford. Ford gets Saudi Arabian money. I mean, I think that that's a deal that makes a ton of sense to me. And I don't think either side would be opposed, which is, in streaming, we're seeing, everybody's got their motivated self-interest screwing up the deals. I think here the Saudi Arabians, which are more Ferengi than the Chinese, are probably open to cutting a deal. I don't think it needs to be a standalone company. If they get manufacturing from Ford and a piece of Ford, which is global, I think they like that. I almost think that this is being developed specifically to be a takeover target. Rivian, I don't think it can catch Tesla. I just think it's too late. Their products are spectacular. Prices are still high. And I don't think that they have the manufacturing scale. And given how close we are to steep competition across the board, I think this is another one that has to get acquired. And I don't know if Ford would be one to bring it in, or GM or Stellantis. I think Stellantis might be a logical takeover partner here. But I like this one because it gives you the American angle, and then they throw in the lithium, which which is South America. You know that I'm pretty high on South America, Argentina in particular. So I think that this is probably one that I use more of in the future. Again, not much Asia exposure there, right? So there's almost no China in that one. So when you take a look at iClean and QClean, you go, they're pretty complementary. You just have to balance them how you want. The other one I like, if I'm building a portfolio and I want more than one fund, is PBW Invesco Boulder Hill Clean Energy, which is a modified balanced. So 73 holdings, all in that one, 0.5% to 2.5% range. So no huge overweighting. This is basically just a broad index. It's about 5% China, 6% China. It has some companies that I think are very interesting. And I think that, this is another great way to get exposure because it is largely small cap. I can find that here. So this is where you're getting your small caps. A lot of them. Some mid caps, not a large cap, right? So this is a mid cap fund. And I think that in this space that's growing, that offers a lot of upside at some point. So the spikeability of this fund is pretty extreme. I think that when clean energy catches fire, this fund might do the best because it has the small and mid-sized companies, and the capital flowing in will have a bigger impact. You take a look at the TAN Invesco Solar. This one's a little higher in China, right? Chinese companies in here. But you have Enphase and Solar Edge, and then First Solar. Interestingly, if you really want to be aggressive on solar, you could buy this and then complement it with a position in Generac, which is getting into the energy distribution and management business and using their legacy business, which is the generators, to basically make all those connections. Generac has really good sales penetration, and you can't understate that. I mean, it's like saying, well, Enphase and SolarEdge maybe have a little bit better product, but everybody talks to Generac. Not everybody talks to Enphase and SolarEdge. So if you're building a building and you say, hey, we're going to get some tax incentives for putting solar on here, we have to figure out how to do it, and you're already doing business with Generac because they do business with way more people than Enphase and SolarEdge, your Generac guy says, yeah, you're right, and we've been getting into that for the last decade. We have a deal with the third biggest or second biggest solar installer in the country, and then we have a energy management system too, and batteries. So I think the Generac, along with this fund, is a pretty interesting play on energy management, storage, and solar. So I probably will do that in my aggressive accounts. All right. I really want you to think about this chart logically from here to here, from here to here, knowing what we know about where spending is, right? How do we deal with this situation? We're probably looking for ways to scale out of fossil fuels over the next 5 to 10 years, but we want to get into clean energy over the next 1 or 2. Now, I mentioned at the very start, I expect 2 buying opportunities. I think one is now, and then one is whenever we get the next recession and financial crisis on the baby boomer retirement. It's coming sometime between 2026 and the end of the decade is what it looks like. I don't think it's 10 years out like Jamie Dimon mentioned. I think it's 3 to 7 years out. And when the boomers cause this big period of angst where everybody's going to say it's the end of the world, remember a few things. One, climate change migration is a big deal. It's already happening. Millions and millions of people are moving around the globe to get out of bad situations environmentally. A lot of that is happening on our southern border. A lot of those folks aren't just coming here because they felt like coming here. It's because climate has changed where they are in many cases, and they can't be farmers anymore. So they moved. They're like, well, we need a better way of making money. Let's go to America. America needs 3.5 million new workers per year because that's how many boomers are retiring, just to keep the economy the same size. Currently, we have 1.5 million a year from births. So we have a 2 million person per year shortfall that can only be filled by immigration. You basically need 4 or 5 million immigrants to get the 2 million jobs, right? Because of the children. So you bring in a family unit and 1.5 jobs come from it. You have the one person working full-time, the other person working part-time, and then raising the kids. And over a long period of time, you build a workforce over the next 20 years that can help take care of the boomers in their old age. You keep the economy from shrinking. Around the edges, AI, with its efficiency, will create a little bit of a gap. So really, to keep the economy growing at 3% per year, you would need more than the 2.5 million jobs. Let's say we just 3.5 million workers. Let's suppose that if we only replace the 3.5 million, AI and machine learning creates the 3% growth. I think that's reasonable. I don't know if that's exactly how the numbers will work out, but something along those lines. The politicians already know, and they've basically come to an agreement, but for politics' sake, they're not going to pass it this year. They already know what they want to do. The bill is out there. It was going to pass. Trump said don't pass it because we don't want to give Joe Biden a win. Now, Joe Biden should have been the first things out of his mouth when he got into office is he should have tried to cut that deal. But he also played politics. So don't think that I'm, just bashing one guy. There's a lot of politics to go around. So eventually we'll fix the immigration system so that it works the right way. People can apply the right way, come in legally, get into the workforce, become part of the system, become Americanized. And most of them coming want to be Americanized. Is there a couple percent that are just shitheads? Yeah. But, we got our own shitheads, plenty of shitheads here. So, if 9 out of 10 people coming to the country are not shitheads, I don't think that's any different than, the people in this country. I'm sure 1 out of 10 of us is a shithead. So, in fact, I think it might be 1 out of 5. But these things are going to work out. So when the next big correction comes and everybody is throwing their hands up in the air and talking about revolutions and civil wars and end the Fed and, storm the Capitol and all this other bullshit, you are going to want to be a buyer. Because the thing that's going to happen then, which I've been prepping you for a year, is that when the Fed decides to fire its bazooka again, it's going to fix everything once and for all. It will finance the economy for a generation, pretty much in one fell swoop. We kind of saw that with COVID. We overspent on COVID, got a little bit of inflation, but look at the growth we're getting. And look at the stimulation of American industry that we're seeing. This is what COVID caused. And Biden passing all those bills. A tripling of manufacturing and construction in the United States. Triple. I mean, these are big freaking numbers to triple in 3 years. And a lot of it is going into this, which means this is going to change. If you can't wrap your head around that, I'm going to tell you the same thing that I always tell you, then you shouldn't be managing your own money because this is the future. And the future is a lot closer than you think. And it might be really close if we get a bad storm this year. Because when the narrative changes, when another couple of percent, and it's really, we're at the loggerheads point right now. When the next few percent of people go, wow, climate change is a big deal and it's going to affect my vote. Now all of a sudden you have a sea change. And those funds that I just went through with you, those are the 5 best funds out there. I've gone through all of them. I've done significant screening. If you use the screener with Seeking Alpha Premium, you just go here and they have some pre-made screens. Then you can do other types of screening and you can set up the filters in a lot of different ways. You just go by holdings and you figure things out. ETF details. In any case, I will post this one for free. And then the stock-based articles on Mondays, probably split those into 2 pieces. One will be the stocks of the week and the other one will be the retirement income options. And on Monday, we're going to go through several specific stocks. So if you want to get the specific stocks, and I already mentioned Generac and Enphase, but if you want the rest of the specific stocks that I'm getting into for this huge transition, you should get a membership, Sustainable Growth Trends at Fundamental Trends, if you just want growth stocks. If you are a retiree, you can either subscribe to Margin of Safety Investing or Fundamental Trends Retirement Income Options. So I would encourage you, if you want to learn how to sell options, and if you want to do everything there is in investing other than swing trading, that's at Fundamental Trends. But we'll do a little swing trading here, not much. This is position trading. This is figuring out how to own things for several years at a time, sometimes forever. If we can get a monopoly on the cheap, right? If we ever get a chance to buy Google cheap again, then you do it. I'm not so sure that those Mag 7 stocks ever get super cheap again. So, you just buy QQQ. In any case, some minor tweaking to the services to make it a little bit more focused and a little easier to use. And on Monday, we're going to cover some specific stocks, two in particular in the resource space that I think are going to be pretty easy triples over the next 3, 4, 5 years. And they could be 5 to 10 baggers. So always nice when the downside is you're going to double or triple your money in the next 5, 6, 7 years or sooner. And the upside is a lot more. So we got two companies that I'm adding to the punch card growth list. One of them has been on before. The other one that I mentioned recently, I've already made my first transaction. I'll be making my second transaction soon. They have earnings coming up, and I think I want to get in before the earnings. So we'll talk about that on Monday. And then we have some option selling to do on Monday as well. All right, everybody have a great Saturday. I will get these posted soon.